Morgan Stanley India Summit. Here are Ridham Desai of Morgan Stanley as he speaks on India's growth story among emerging markets. He believes stocks will eventually take a cue from the bond markets and follow the high growth path.
The broad markets are doing a local thing. The large indices are doing a global thing. And it's exactly what they did last year, which is last year the large cap did a global thing. So they were up like 28-30%. The small caps were up 60% in dollar terms, 70% on average. Okay, so they did their local thing, right? So now we are seeing a reversal. I think sometime in January, in the middle of January, I think the sentiment changed, largely because of global factors then. So there was a protectionist thing and a couple of few factors came together which kind of caused a correction, and then that's self-fulfilling. Because once that starts, you have such a large gain sitting on behind you that I think it's taking a little while to get flushed out. And to my mind, it's about where the valuations are. So at the end of last year, mid caps were trading at par with large caps. They usually trade at a discount, so they need to trade at a discount, and maybe 20%, maybe 30%. Hard to say what that number should be, but somewhere around there is where I think the mid cap or the broad market, as you cite, will kind of bottom out. It has not yet, in my view.
How much more to go, you think?
So the drawdown is, I think, as of yesterday, about 14 or 15%.
Okay.
During the demon correction, we had 16%. In February 16, which was a global correction across markets, it was 20%. So can this do a 20% correction from peak to trough? I think that's pretty par for the course. So that doesn't mean that the market structure has broken down, but for now, I think large caps still continue to look like they'll outperform mid caps until this whole thing is flushed out. And then I think the most important thing is that I'm not expecting a V-shaped recovery in mid caps, which is after they trough out, I think they will take some time to gather momentum and bottom out actually. So that process could
Do you think
continue.
they'll drag the large caps as well? Because that's a bit of a leading factor that's always at play.
Unlikely. I think India is looking like it's outperforming EM this year. Because India's macro is a whole lot better than it has been for the past 3 years, especially relative to EM. There is a risk about oil, so keeping that aside, because if oil goes up a lot, then that gets disrupted. We do have an election in front of us, which is also another drag on the market. But growth is turning in India, and India's beta has actually crashed. So we just did some work on this, and if you look at India's beta, it's approaching multi-year lows. India's relative volatility is at all-time lows. India has become a very defensive market. So in a world that we generally think is not going anywhere, so it's our global view that equities are going to struggle, India will actually be okay on a relative basis. So I think large caps are fine. But I'm not expecting major returns.
So let's measure the market on three buckets, the three most important buckets. First is liquidity, second is earnings, and third is valuation.
Okay.
And would you like to do this measurement for us for mid cap and large cap, or would you like to measure it universally? Three sectors which have surprised us negatively and positively. First is PSU banks for all of us. 5 years ago, we thought that the problem would come to an end. They were recapitalized. Nothing's happened there. Second is the rise of NBFCs. They've really surprised us in terms of market share gain, and some of the franchisees, some of the companies have done. Now, we often say that there's a power of cycles which work in stock markets. What has worked in the past may not rhyme itself in the future, may not work in future. So this is 2018. Let's talk about one or two mega trends.
So the first is on inflation. Okay. The inflation framework for this country has changed because the central bank has a mandate. So they are going to be cautious because they cannot exceed 6% CPI. So unlike the past, they'll take lesser risk with inflation, which means earlier rate increases, right? Which means lower volatility in growth rate, which means lower nominal equity returns.